Hello everybody. Well, it's a new month, November, but it's the same old shit. So FOMC this week was quite interesting. It was on the 2nd of November. But I think the key conclusion is the Fed funds rate, the peak of the FFR is probably going to be higher than 5%. Market is pricing roughly 5 to 5.25%. So let's do a little summary, and this is the transcript. I think some points were quite interesting. The first thing is that they acknowledge that the monetary policy will come with some lags. Because if you look at what's happening right now, I think the common consensus is that inflation will just come off next year or something, especially with the rental and the housing, right? You can see that the housing market is softening very fast with a 7% mortgage rate, and therefore the rental should probably fall something like 12 months to 18 months subsequently. So I think they are acknowledging that there are some lags and inflation path looks to be softening, I think. So this is somewhat dovish. The second thing is that it will be appropriate to slow the paces of increment. So this is quite repeated a few times already. So this is also somewhat dovish. But the last point though was the most significant, and that was very, very hawkish. See, they have some ways to go to increase rates, and I think this second part is damn interesting, damn important. The ultimate level of interest rates will be higher than previously expected. So previously, right, the expectation is at 4.6% Fed fund rate peak. So I talked about it in a video previously. I'll put a link over here. You can go check it out. And that Fed funds rate of 4.6% was already an increment from the previous expectation of something like a 3.8%, right? So we went from 3.8% to 4.6% in 2 months, and now we are looking at something at 5.5% already. So this is, I think, the most important part. That the Powell is saying that the peak will be higher than previously expected. So I think the market is just repricing everything with a Fed fund rate of more than 5%. How much higher than 5.5%? I have no idea. But look at the 2 years now, 4.7%, and 10 years now at 4.2%. So, well, I think the market is just going to reprice to price in a 5% Fed funds rate at least. I think the path is quite interesting because if the 2-year US Treasuries hit a 5% rate with the FFR rising as well, then what will happen to the 10-year Treasuries? Because if you look at the current pace of the economic slowdown, be it GDP or the inflation, it looks like the US is going to head into a recession pretty soon. In fact, it's probably going to be a pretty bad recession, I think. Consumption is slowing very, very fast. Housing market is crashing, and housing pretty much leads the economy, right? So if the treasuries in the 2-year goes to 5%, would the 10-year treasuries move up to close to 5%, or actually with the 10-year treasuries yield fall to reflect the recession that's incoming? And I think this is a very important thing because if you look at the prices of REITs, the prices is essentially the net property income minus interest costs and some other stuff, and then you divide it by the discount rate, right? So let's take a numerical example. So let's say now the NPI is 10, and then interest cost is at 2, discount rate is at 2, then 10 minus 2 is 8, and divided by 2, that's 4, right? So the price is 4. But what happens if the interest costs go to 5%, but the discount rate actually falls? So if let's say the 2 interest costs go to 5, but the discount rate falls from 2 to 1.25, then actually the price doesn't fall. So 10 minus 5 is 5, divided by 1.25, that's 4. So actually if the 2-year goes up, but the 10-year goes down, then the price actually doesn't move much. But on the other hand, if the yield curve moves up in parallel, then things change, right? So if you have interest costs go from 2 to 5, and discount rate goes from 2 to 5, then it's going to be a big move now, right? Because 10 minus 5 is 5, divided by 5, that's 1. So you can see actually the path forward for the price for the REITs and all other REITs assets will really depend on the shape of the yield curve going forward. So I think there's no doubt that the front end will move higher in terms of yield, but the behavior of the back end is a bit debatable, I think, because I think the recession in the US is probably confirmed, I think. If you look at what's happening in Europe, it's definitely gonna be a recession, right? If you look at the Bank of England's projections, if rate paths go much higher, you're looking at the 2 years of recession, right? And Asia is not doing very well as well. So I think the shape of the yield curve moving forward will be a very key component of what decides the share prices of risky assets going forward. So interesting times ahead. This is historical and uncharted territories. Good luck, everybody.